In this example problem, we are going to be a company that has a bunch of receivables on our books, but we need cash immediately. So what we're going to do is we're going to turn around and we're going to sell those receivables to a third party called a factor. And the factor will give us cash now, but they're not going to give us the full face value of the receivables. They have to make their cut as well. So this factor, Frank's factors in this problem, is going to take their cut out of these $500,000 worth of receivables that we are going to sell to them. Firstly, they're going to hit us with a finance charge, and their finance charge is equal to 5% of the face value of the receivables. That's theirs. That's the money that they make for giving us cash now so we don't have to wait to collect on these receivables later. But they're also going to retain 3% of these receivables for what they call probable adjustments. Bad debt is a real thing. Some of these receivables that we're selling to Frank's Factors might end up not being collectible in the long run. So Frank's is going to hold back a little bit of the money that they should be sending to us in case there is bad debt in there. If the bad debt doesn't come to be realized, well, then they refund us the cash. But if there is bad debt in there, they'll take it out of the amount that they're retaining for probable adjustments. The third line here states that this is made without a recourse provision. What is a recourse provision? It's a guarantee in a contract when you sell to a factor that if the amount of receivables that you are selling them, or sorry, the amount they're retaining from the receivables that you're selling them isn't sufficient to cover the bad debt, that you are therefore obligated to make them whole. So if we did have a recourse provision and the bad debt ended up being more than 3% of these receivables, we would have to pay Frank's the excess, the extra amount of bad debt that was in there. But since there's no recourse provision in this contract in requirement one, if there's more than 3% of receivables in here that are bad debt, Frank's is going to have to eat it. They're taking the risk on this one. So let's record this May 1st entry to account for the factoring of Banjo's receivables to Frank's factors in a deal that doesn't have a recourse provision. Well, the first thing we're going to do is on May 1st, we're doing this for one reason only, because we want cash. So what amount of cash is Frank's going to receive in this instance? Well, we're selling them $500,000 worth of receivables. But we're getting hit with a couple of charges. Firstly, the finance charge is 5%. And secondly, they're going to keep another 3% of that $500,000 in case there's bad debt in here, which means they're holding back a total of 8%, and they're only going to transfer us the other 92%. So for our cash, it's equal to 500,000 times 92%. And that comes out to be $460,000. We are getting hit with a 5% finance charge. So they're going to take it no matter what. Even there's not a penny of bad debt in here. They're going to take that 5% of this $500,000 and keep it for themselves. And as the company that's selling your receivables, you write that off as a loss on the sale of receivables. And again, losses aren't exactly expenses because they come from things outside your typical course of operations. But in terms of debits and credits and all that stuff, they work the same. So let's pretend this is an expense right now. What amount do we know that we're missing out on right here? Well, we could have gotten $500,000 if we waited and all of this got collected, but we're selling it to them, letting them keep 5% of it for themselves. And 5% of $500,000 is going to be 25,000. So we know we're out $25,000 no matter what. That's Frank's cut on this. But they are going to also hold back some for probable adjustments for potential bad debt. And I'll math that out first. They're holding back 3% of the receivables value. So 500 times 3% is how we find the amount that they're retaining for adjustments. That's going to be a debit as well. 500 times 3% means they're going to hold on to $15,000 in case there's up to $15,000 of bad debt in these receivables that we're selling them. But if there isn't, they have to send us that back. That's not part of their finance charge. It's just a little extra on it, which means we're going to treat this like it's a receivable to us right now. They're holding that money back, but they do owe it to us if they end up collecting on all of these receivables. And we're going to call that the very fancy name of due from factor. it's accounts receivable, but it's accounts receivable from a factor. So we don't want to get it mixed up on our books where we think it's from a customer or something. So we're going to give it a different name. Speaking of accounts receivable, right now, I know I need my debits to equal my credits, and I've only got one space left in this template right now. I need a credit of $500,000. But what has a value of $500,000 that needs to come off of our books? The receivables that we are back. So here we're going to take accounts receivable off of the books. And here we factored receivables without recourse. So in our second entry here, we're going to do a what if, if you will. In this case, it's what if instead of there wasn't a recourse provision in here, there is a recourse provision. Well, if that's the case, then if there's a recourse provision in there, it has a fair value. And that's basically the expectation of what amount of bad debt is in there. Well, you might be thinking to yourself, wait, they held back $15,000. So how could their estimate be $18,000? The factor held back $15,000 based upon their estimate. But our estimate in this case is $18,000. And we're never going to go to them and be like, no, send us less money because we think there's more bad debt in there. We want cash now. So the difference between what is due from factor and the fair value of a recourse provision is the two different parties' estimate of what amount of bad debt exists within these receivables that are changing hands within this transaction. But this is a alternate universe, if you will, journal entry we're recording. So it's still going to happen on May 1st, and we're still doing this to get cash. Well, in this instance, there's nothing differing here about the actual amount that we're going to receive up front. They're still actually hitting us with a 5% finance charge, and they're still actually going to retain 3% of the receivables value for probable adjustments, which means we're getting $460,000 of cash. As I said before, they are also going to hold on to 3% of those receivables for probable adjustments. So our due from factor is still going to have to get debited for 15,000 if there was a recourse provision in this contract. And we're obviously not getting full face value, so we're still going to have a loss on the sale of receivables. Pluralized the first time for some reason. There we go. But we're not going to fill in that number right now. All these receivables are still getting sold. So even if there was a recourse provision, we'd have to take the accounts receivable off the books, and that'd be for their face value of 500,000. And then lastly, we think that we've got a liability going on here that we're going to have to pay them for this recourse provision. And we're going to call that recourse obligations. Nope, liability going on. So we are estimating that there is substantially more bad debt in here than Frank says, and we're going to end up having to pay them $18,000 to make them whole at the end. So let's put that liability on the books for $18,000. Well, now my debits don't equal my credits. What would I need here? Well, I can go through and do a little math to figure out what that's going to be to make my debits equal my credits. 43,000. Can I make sense of that number? I absolutely can. We know we're losing $25,000 for the 5% finance charge that they're hitting us with. But on top of that, we think we're going to have to send them back another $18,000 once this recourse obligation gets settled. So between the finance charge that we wrote up the loss over here and the eventual amount that we think we're going to have to pay for this recourse obligation, in the long run, our loss on these sales receivables is expected to be 43,000, and you have to record expenses and losses in the period that they occurred. So while we don't know what it's actually going to be right now, we are going to record this, assuming in this case that in the long run we are going to lose out $43,000 on these receivables. And here we factored receivables with recourse. In requirement 3, we're going to go into the future and we're going to say that on May 31st, Frank's Factors contracted Banjo board games in here and informed them that there was $17,200 of bad debt in the receivables that got factored. And they're enforcing the recourse provision in this contract and making us pay the excess amount of bad debt above, what they retain for probable adjustments. Let's just start right there. What did they retain? They retained $15,000. That was the due from factor that we put on the books. Well, there's actually $17,200 of bad debt. That's $2,200 excess, if you will, of that we're going to have to send them in the form of cash to make things whole right now. So what are we going to do in this journal entry over here? And again, this is a extension of two over here with recourse in the contract. Well, we're making things whole, so this recourse obligation has to come off the books for its full amount, which is 18,000. Due from factor is refundable if and only if the bad debt that's in there is less than the amount that they're retaining. Well, in this case, the bad debt is not less than the amount that they're retaining. The bad debt was actually more. We're not seeing a penny of that. So we got to take that due from factor off the books. I'm going to credit that for $15,000. And then, as I said earlier, that $15,000 that they withheld isn't sufficient to cover the $17,200 in bad debt. And if they're enforcing this recourse provision, we have to pay them the difference between the actual bad debt and the $15,000 they retained, and that would be $2,200. I guess for the sake of having math for your notes over there, I got that from 17,200, the actual bad debt, minus the amount they originally retained. And then we've got our loss on the sale of receivables that we have to fix. In this case, it's going to be a credit. So while that 17,200 is more than they estimated, it's less than the 18,000 that we estimated. If I go through right now and figure out what I need to make my debits equal my credits, I need to put the formula in, right? I need to have a credit of $800, which makes a world of sense. Our estimate for the recourse obligation was $18,000. There was only $17,200 of bad debt that existed within here. So what we have right here is that we settled the recourse obligation with Frank's. And below this, we can do a little bit of math, income statement style, if you will, to see if our numbers are checking out. So the original net value of receivables that we factored was $500,000. Let's subtract out the amount of cash that we actually received. On May 1st, we received cash when we factored these receivables. That was 460 grand that we received. On May 31st, we didn't receive any cash. We actually had to pay $2,200 in cash back to them. So what is the net amount of cash we received? Well, if they sent us 460,000, we essentially had to give them 2,200 back. Net, we received $457,800. Well, that means for receivables that were valued at 500 grand, we only got 457,800, and our loss on the sale of these receivables is going to be 42,200 bucks. Well, what would my loss on the sale of receivables T account look like right now after we've recorded all these transactions? Well, again, we're just going with the with recourse section right here. We originally recorded $43,000 loss with a debit. Over here, we had an $800 credit to loss on sale of receivables. And if I find the balance of this account, lo and behold, it's 42,200. So with our proper bookwork right here, we recorded a loss, albeit over a couple of transactions, that actually ended up being how much less cash we received than the face value of the receivables. Moving on down the line right here to requirement 4. We're going to assume instead on May 31st, and a lot of insteads going on in this problem, that Frank Factors is going to contact Banjo Board Games, us, and inform us that there was $14,000 of bad debt in there. So now it is not only less than our estimate, it's less than Frank's estimate. What happens in this instance? Well, let's go and put this on the books on May 31st. That recourse obligation still has to come off the books. So recourse obligations is going to get debited for the amount we originally put it on. This is an extension of this entry right here. So recourse obligations is getting reduced by $18,000. we're settling with them, so we can't have anything on our books due. So I'm going to skip down to the third line and I'm going to put due from factor on the books. Well, I shouldn't say on the books, off the books, taking it off with a credit right here. And now let's go through and figure out what happens with the cash. Well, they retained originally $15,000, thinking that was the expected amount of bad debt that Frank's thought was going to be in here. Well, it only ended up being 14,000, and this is not a straight up charge up front. It's there just in case. And in this case, there wasn't as much bad debt as the amount that they retained. So now they owe us the difference. And I'm going to debit cash in this instance because we're the ones getting the cash back. So that's the difference between the $15,000 amount that was being held for probable adjustments and the actual amount of bad debt that occurred in this entry. And now I need a credit over here that's going to make my debits equal my credits. So I've got $19,000 of debits and one $15,000 credit, which means I still need a $4,000 debit. Well, what could that be? Well, $4,000 is conveniently the difference between the $18,000 that we estimated originally that was going to be the amount of bad debt in there and the $14,000 of bad debt that was actually in. What that means is we factored that 18,000 into our loss. We overestimated. Our loss is valued now $4,000 too high, and loss on sale of receivables needs to go down, and conveniently it goes down with a credit to that account. So let's do that same table and math check us right here. Oop, got the wrong thing in here, sorry. I don't know why there's already a description in there. We settled recourse obligations with Franks. It's going to be the same thing as before. So what is the net value of receivables? It was $500,000 that we started with. And we, in this case, received $460,000 up front when we factored. Well, now in this alternate universe of requirement 4 over here, they need to give us another $1,000 when they refund us what was due to us because their amount that they retained was more than the actual amount of bad debt in there. And I find the sum of these numbers and I get 461,000. And then if I take 500,000 minus 461 grand, I come up with 39,000. Does that make sense with our loss on receivables T account? It sure does, because we would have originally, in this deal with a recourse provision, recorded a $43,000 debit to loss on sale of receivables. And over here, we had a $4,000 credit to the account, which means that the difference, or the balance, if you will, of loss on sale of receivables is indeed the same as the difference between the value of the receivables that we factored and the actual amount of cash in the long run that we ended up receiving.